Hello everyone, in this video I'm very excited to share with you my step-by-step process of analyzing a stock from complete scratch. In this case, we're going to be analyzing Datadog, but this is a process that you can implement and that translates very well to different kinds of companies. And what you're going to see is just live. This is going to be a long video, I'm warning you, but it's going to be super helpful because what I'm going to do is I'm going to take you through the different tenets of a good stock analysis, and we're going to go through analyzing the market, the management team, valuation, company health, product, all of this step by step. And this is something that a lot of people have asked me because I analyze a lot of stocks. I used to work as a financial analyst for many years at one of Canada's largest real estate investment trust, and of course now I'm the CEO of Whitesheet. So stock analysis, stock valuations is something that I see and I do almost every single day of my life. So I wanted to put together a video for you, but also for the people at Whitesheet so that they can see how I use the product and how I analyzed a lot of stocks. I know there's been many people that have asked about it, and this is the exact video where I'm gonna walk you step by step. At the end, we're gonna have our analysis that is gonna look something like this. We're gonna have the different financial statements that we're gonna go over together. We're also gonna be doing some online research, so you're gonna see some of the skills that I applied to get quality information that we can use on our analysis, as well as different spreadsheets and different templates that help to visualize the performance and the metric of this particular company right here. Now, like I said before, the really valuable thing about this is that at any moment you can just change the company, apply the same process, and for the most part, I mean, there's some differences between different companies. You're going to be able to perform a good solid stock analysis that you can use to make a good investment decision. Okay, so to begin our stock analysis from beginning all the way to the end, what I'm going to be doing is I'm going to be using this spreadsheet, which I'm used to using. Now, don't look at these numbers. I was just doing some rough analysis on Atlassian. But what we're going to do is we're going to fill all of the details of the spreadsheet step by step. But most importantly than the spreadsheet, what we're going to do is we're going to go through a very rigorous process of evaluating the most important parts of the company. And this process, as you can see, and these tenets you can find right here. This was inspired to me by Warren Buffett, who is always talking about these different tenets, as well as Peter Lynch, and also my own experience working as a financial analyst for one of Canada's largest real estate investment trusts. So with that being said, let's get started. The first thing that I like to do when I'm analyzing a company, in this case, we're gonna do Datadog, and I'm gonna explain the reasons why later on. But the first thing that I like to do is to read the company's annual 10K report. And this is really powerful because it really gives you a great overview of the company, what the company does, the goals of the company, what the company is trying to achieve, etc. So that is the first thing that we're gonna go ahead and do. So for that, we're gonna go right away to Google and look for the 10K. So here is one. This looks like is the latest one, which usually the latest one is the best one to use. And then we are going to get the PDF. Now, if you are on Mac, or you can also do this on Windows, what I recommend that you do is that you download the PDF. So I'm just gonna put it on my downloads folder right now. And then from here, what I'm gonna go ahead and do is open the PDF, but this is gonna be way better because now I can put it in full screen and I can look at 2 pages at a time. And then with my keyboard, I can just go quickly over the main sections. So to start off, I don't like to go into the financials. I don't like to look at the company's market capitalization or stock price or anything like that. I just wanna know about the business itself. And Datadog is a company that's very interesting to me because I've been using the product recently and I really like it. And I heard a lot of really good things from people that I respect in the corporate world and the IT world as well. So I really want to know what's up with this company. Is it a good investment? What's a good price for it? And that is something that we're going to figure it out together step by step as you follow along in this journey. Now, one last thing that I have to leave you with is that this is not going to be the complete analysis. And the reason why is because that would take forever. I mean, a really in-depth analysis of a particular company can take days. and we don't want to make a YouTube video that's 1 day long or so on. So I'm going to try to condense the information, but still provide you with all of the most important things that you need to know, as well as the process step by step. So let's get started. So first, a company always talks about the risk factors. Here, what I'm looking for are risks that are out of the ordinary. So right now I'm looking at the different risks right here. I don't see anything that is out of the ordinary. This is something important to know. The dual class of the shares is very important because that means that you as a shareholder, you're not going to have a lot of influence and impact over the company. That's just something to keep in mind. So what I like to do actually is, as I'm doing my research, I go back and I take different notes. So for example, like here are some notes that I took for Amplitude and Atlassian in this case, and I have links. But here, what I'm gonna do is I'm just gonna be taking some notes right here. So first we have dual class structure, shareholder control. So something important. Now we get to the business section. This is very important. Observability and security platform for cloud applications. Okay, now we know what the company does. So this is interesting. They're giving you some information that they've gathered about the market, which in this case is the IT operations management market. So I'm just going to take a note of this, and we're going to look at this data ourselves because we don't want to just take the company's words for it. But in this case, it's going to be 62 billion market by 2026, IT operations management market. Yeah, okay, so this is very important. And just to summarize the information that we can see here in the business section, the company talks about its current platform. And basically, the problem that they're trying to solve is that if you have any type of software solution out there, we have this problem at White Sheets. The issue is that sometimes it's hard to track what's going on inside the app. And tracking can include many different things, such as like knowing usage, such as knowing if there are any issues that users are having, and just being able to monitor if operations inside the application are being performed efficiently. And so Datadog is the platform that is aiming to make this process a lot more transparent and easier for people to do, so that you can have your applications running smoothly without so many bugs and issues on the background, and you can monitor that quickly and in a way that's easy to do. So this is great. Something very important about their business model is that they are mostly self-serve. So that's great because the cost of adoption is low, and so they can get a lot of customers. And then if the product is good, which in my test has been pretty good, price their product based on usage. So the more you use the product, the more you paid for it, which is great because if the product is very good, then you get more money just from the existing client base. So that is a really positive thing. And it looks like they've built a whole ecosystem of different solutions around this area. So that is a very positive thing. This is interesting. There's a lot of different aspects to the platform that it is mentioned here that you can go for, but scalable, this one stands out to me because if they're serving trillions of data requests, I mean, props to the engineers for being able to figure it out. I wonder though if they're overestimating their ability to scale. But everything else looks really good. Integrated data platform, simple but not simplistic. This is great because that means they can target the smaller businesses as well as the large enterprises. The self-serve, it's great. Collaboration, super important for enterprises. And then machine learning and artificial intelligence, that's great to be able to identify issues early. Yeah, so when I started to use the platform, this was the main driver that got us to be interested in it. And so far, it's been a great solution for us. This is such a blank statement because it doesn't mention exactly how they're doing this, but that's interesting. Yeah, so they're building a suite of products that's really powerful, and it really helps to build a moat around the business and get the existing customers to be sticky, meaning they don't have to go ahead and look for other solutions, and they're gonna remain loyal customers for a long time. So I'm gonna take a note of that. Build with data, suite of solutions, and high switching cost. Yeah, high switching costs. So switching costs basically means that it's hard once you get set up with this particular platform to change to another one, because you basically have to set up the entire thing from scratch. Lots of integrations. That's really good because, as we know now, data comes from everywhere, especially for businesses. So being able to extract that data from different sources is key to be able to monitor all that data in one place. Even this is really powerful, so that if you have any specific issues in your application, you get notified right away, and you don't have to wait for a million support emails to come into your inbox to be able to create a solution. Okay, perfect. So here's the different products that the company offers. So we have infrastructure, monitoring, application performance, log management. For this particular type of company, it's very important and really interesting to look at the breakdown of the revenues to see by product which products are generating the most amount of money. You can analyze this company as a whole, or you can also break it down by the product. And that provides you with some very interesting insights when it comes to the company valuation. So it looks like the sales force is regional, and yeah, they have a whole bunch of different onboarding systems for different types of clients. So if you're a large client, there's somebody that's going to handle your entire process of migration, which is great. What becomes hard though about marketing for a company like this is that when you have too many products under one roof, it becomes hard for people to know about all the different products and the value that those products offer. So something for us to keep in mind. Yeah, so this is great. We can see what their different competitors are for their different solutions. One thing, we're going to go into the competition more detail a little later on, but one thing that's very interesting is the competitors right here. Some of these companies are very old. They've been very good at building relationships with large enterprises, but if you're able to market in an innovative way, as Datadog has been doing, or looks like they've been doing, we're going to do more research, then you can really reach the kind of medium to small enterprise companies and get those people as they grow and become large enterprises. You get them early, so that way you don't have to compete as hard with the existing monsters in the market. 4,800 employees, that's great, across 30, wow, that's a lot of employees. I like how they say low drama. Yeah, so that's interesting. They do have some patents. I do wonder though, these patents, how useful they actually are, and if they actually provide any kind of competitive advantage over the other market players. Especially in software, where it's much harder to build sustainable competitive advantage just off of patents, because you can get around those in different ways. Now we're going to the risk factors. So here we're looking again for risk that is like out of the ordinary. So unfavorable competition. Okay, but this is like, this can affect any other business, right? So this type of risk, like, it's important to keep in mind and be aware of this, but there's other risks that are more important to pay attention to. This is another type of risk, especially as it relates to the stock price. We're going to talk about that later. Yeah. So one thing that is important to know is that the company has operating losses, so something to keep in mind. We will get into the financial analysis later, but this is just a little note there to keep in mind. Yeah, this is a very strong risk for this company. As the company becomes very large, the risk of cybersecurity attacks becomes more and more prevalent, and so this could be huge. Yeah, this is a real risk for the company. It looks like they're doing what they can, but it's still something to keep in mind. So for example, here's another risk that's kind of silly, seasonality. That goes for all businesses, right? So yes, this is a key one. So it says they target enterprise customers. So it looks like in the beginning they were kind of doing more like, maybe medium to small size companies, but now they're targeting the biggest companies that there are out there. So this, of course, has a high degree of risk in a way, because more of your customers, more of your revenue comes from a smaller set of customers. But at the same time, once you get those customers, usually they stay in for a long time and they have a contract. So that could also be a good thing as well. This is another one. We use open source software. So this is important because if the terms of that software change, it can really affect them. However, I would assume that they will be smart enough to use software which is not likely to change. This is good, the fact that they're protected in some ways for unfriendly takeovers. That's always a good thing. And that's it. We've gone through the risk factors of the company. Now here, what I'd like to just is skim to see if there's any valuable information. So this is kind of similar. We've kind of gone over this. So now they're explaining the different categories of the financial statements. I'm not going to get into the financials just yet. And the reason why is because I like to do that later once I have a clear picture of what's going on in the market, the company, the competition, etc. So here we go. Now they're giving us the financials as well as the notes of the financials. These are very important to go over once we're actually doing the financial analysis of the company, but right now we're okay. Okay, now let's talk about reconciliation, and now we have some more notes, some more information. Okay, perfect. So that's basically what I like to do when it comes to reading the company's annual report and understanding the company a little bit better. Now here, there might be some questions that you have, and so this is where you do your own research to get the answers to those questions. So one of the things that I want to do actually is I want to go to the Datadog website, and I want to see exactly what their pricing is for different products. So that's going to be interesting because that tells you a lot about, yeah, here we go. Yeah. They have all these different products, so that makes it tough. Makes it tough because now you gotta look at all these different solutions right here. Okay, but here, okay, we can start with a couple of them. So it starts at 0 up to 1 metro retention, up to 5 hosts, starting at $15, $23. Okay, log management per ingested scan GB. Okay, so this they're charging per gigabyte. That's good. Per host per month. Okay, so the pricing seems very reasonable. What I do like too is the fact that they continue to scale it, because large enterprises, they see a lot of activity. And so if the pricing is based on that, yeah, then that's great because you start with a low cost. So everybody's like, oh, let me try this. Let's see if this is good. Next thing you know, like as you scale your usage, your price goes up. And so the company is able to make more money, and they don't really have to do anything else like sell you on something else. So there's scale in terms of the product, and then there's scale in terms of like, okay, I like the serverless monitoring. Now I'm interested in some of the other solutions like audit trial, for example, right? So that's very important to the business model of the company. Now, one thing that I want to know as well is if I could get the revenue breakdowns of the company. So for that, what I want to do is I'm actually going to use Y-Sheets for this. This is an add-on that works on Excel and Google Sheets and allows you to get data. So in this case, we're going to get data for Datadog. Okay, so this is the ticker, and then we're looking for segment revenues, and then we're going to do this for the last year. So this is going to give us the segment revenues for the last year. Let's see. Okay, it looks like they perhaps did not report this number. I'm curious if this was reported in the company's financial statement and the 10K. So let's see. Yep, so it was not reported, but what we can do is go to the SEC right here. This might take a little bit. And then we're going to enter Datadog. And now I don't know why the SEC website used to be a lot faster, but you see how it's continuing to load over here. You kind of have to wait until it finishes loading. Okay, now it finished loading. So let's see, we have Datadog right here. We're gonna go to the 10K report over here, and we're gonna see, click interactive data. We're gonna see if the company reported any breakdown of its revenues. So we like to look at node tables, and then here we're looking at, let's see, we have some revenue, fair. So in this case, revenue is the one that makes sense. Okay, so they don't break down the revenue by product. I don't like that. I'm curious if there's information we can find about this, but if the company doesn't report it, then there's nothing we can do. However, we do have the geographic revenue breakdown, which is not very useful, to be honest, because we only have North America and international. So not the best, but hey, at least we have some information. Let me see if we can see Datadog revenues by product. Yeah, this is the revenue by market, which they reported. Okay, so here they give you some insights. Yeah, they provide details of financials and stuff, but they don't provide you with the breakdown. Okay, that's too bad because I really wish to understood where the revenue is coming from per product, but that's okay. Duo in IT operations market, they build a strong mode data suite with high, okay. The company is losing money. So there's a couple of things that we gotta go over. So now we have a little bit better idea of the product and the company health. Now what we're gonna do is we're gonna look at the market. So for the market, what we're gonna do first, I want to see if this is true. IT operations market projected growth. Okay, let's see. So this is interesting because this is a different number by 20. Oh, it's expected to reach basically 35 billion, and this is a much lower number than the 62 billion, but this is LinkedIn. I don't know how legitimate that is. Okay, we're gonna go right here. This looks better. Grandview Research is one that I've used before and it's pretty good, so we'll see. And then we're gonna look at this. So I like to just look at different sources and look at what the consensus is. So 22 billion projected to touch by 35 billion. Interesting. Wow, 4.4% CAGR. That's a very low CAGR. Market projected CAGR 4.4% and 35 billion in 2031, and this is 35. Okay, so that's good to know. Let's see if this makes sense with the other information. So 26, 28, okay, 52 billion, okay, projected CAGR. Yeah, so it looks like maybe 5%. Interesting. Okay, let's see. So 12%. But this is manufacturing operation, so this is different. So let's get out of here. This is IT operations. This is given low number here, very high number here, 37. I don't know. This doesn't seem accurate. So ideally, the goal would be to continue doing research on this, but let's just keep things simple and let's just take kind of like an average or a reasonable number. So it looks like maybe 6% is the growth, and then the market maybe is gonna reach like 40 billion in 2031. That seems pretty reasonable based on what we read. So we have a better idea of the market. Now what we want to do is look at the competitors for Datadog. So here these pages are pretty helpful because they really tell you about the competition, and then this I actually really like for some reason. I really like to look at the Reddit post because people are very honest when it comes to like they're sharing their experiences with different tools. So I'm gonna look at this solutions right here and let's see what we find. So Datadogs, okay, so we have CloudWatch. Yes, this is a huge competitor, and the reason why is because if you're using AWS, this is already built in and integrated, so that's huge. IBM, Splunk, okay. Yeah, so this is a really good one, but what I've heard and what we've experienced is that sometimes this is not enough for what you're looking to analyze. That's the problem. Logic Monitor, I never heard of this. Mid-market companies, okay. IBM, I feel like this could be good, but let's see. Enterprises to mid-market, okay. Splunk, I heard of Splunk before too. Mid-market and enterprises. So everybody's kind of mid-market and enterprise. That's what I see here. Dynatrace, I heard is pretty good. This is mostly enterprise. Okay, let's see. Is Datadog only for large enterprises? Let's see if this is true. Yeah, so that was true that they serve a lot of financial companies. Monitoring and analytics, yes, that's exactly what we saw. Okay, accommodate both small startups and large enterprises. That's interesting because, at White Sheets, we're not a huge enterprise just yet. But for us, it seems like the solution has been very good. This is why I got interested in investigating Datadog. Okay, let's see what else they say here. Dynatrace, New Relic, App Dynamics, Azure Monitor, CloudWatch. I want to look more into Amazon CloudWatch. It just makes me want to look to see what's going on with this, guys. And I will take a note. AWS CloudWatch, big competitor. Yeah, this looks very good. Visualize, analyze end-to-end observability, operate with automation, how it works. Yeah, so a lot of startups are really going with AWS, sometimes with Azure and sometimes with Google. So that would be a problem for Datadog because the convenience of just integrating it into your existing workflow is really powerful. Okay, now what we're gonna do is we're gonna move into Reddit. So let's see what people say about Datadog. This is great, especially having logs. Okay, that's good. Okay, that's a very fair assessment. Okay, so this is interesting. It looks like maybe it's a little too much. This is interesting. However, I think what the person's missing here is that the previous data, you cannot, I don't think you can migrate that to the new platform that you decide to use. Okay, so I think that's as much value as we can get from this thread. Let's see what else we have here. Interesting, not happy with the billing. Small startup, okay. A lot of people are talking about Prometheus. I want to look at the software. So this is something we're gonna look into it in a second. Loki is another one. Now it also depends on your engineers. If your engineers have experience with one particular software, they're gonna gravitate towards that one. Datadog has a really good grip on engineers, so just something to keep in mind for the analysis. Okay, I think we have a good idea of what's going on here. Why is Datadog easy to onboard? Okay, this is great. Fast, look, okay. Expensive, oh, expensive AF. Custom billing convoluted. Interesting. So if the project is small, it's not worth it. If there's a lot of tracking to do, then it gets very expensive. Okay, so it looks like the support also has decreased in quality. Now, a lot of people on Reddit are very cheap, so just was something to keep in mind. I mean, a lot of companies, I'm sure they don't mind paying large sums of money so that they don't have any errors that causes them to lose even more money. So, oh wow, 250,000 per month this company's paying. That is insane. That is insane. Wow. Okay, let's see what else people are saying. So the main thing that's really important here is nobody's really complaining about the product. People are complaining about the price, and the price is something that the company can easily change if it really becomes a bad problem. That's a very, very good sign on Datadog's end. Yeah, and it looks like all the competition is doing the same, right? Because they want to maximize the value that they get. So that's interesting. Okay, let's go see the last one. Yep. So it also depends on the product that you're looking for as well, of course. But this is pretty positive. Let's see. Datadog, okay. By the way, 4.2 stars. Okay, something to keep in mind. 4.6 stars, that's really, really good. Atos, Dynatrace, Logic Monitor. So this is the same kind of tools. Is this from Asana? I'm curious. That's okay, we need to know. Let's see this Prometheus. This Prometheus looks interesting. Power queries, dimensional data. Right away from your website is like, I don't even know what the heck is going on. Maybe it's because it's all documentation based. I don't know, this seems a lot more complicated. Okay, so this is how you make a query. Okay, so that's good to know. Now we know a little bit more about the competition. I think in terms of the competition, it looks like Datadog is really ahead of its peers in terms of the fact that they offer all these different solutions. The billing is really good from the business perspective, maybe not for like the small businesses that don't have the budgets for it. And yeah, the competition, mainly the one to watch out for is AWS because they're a monster and a lot of people already use their infrastructure. So that's something to consider. But other than that, I think Datadog is really well positioned in the market and they have some strong competitive advantages that they can leverage to continue to grow more and not have to worry so much about the existing competition. So that's great. We've analyzed the market. We've analyzed a little bit more about the company, the products we've looked at, and I tried the product myself. I'm not gonna, do it over here on a live version, but the product seems really good. We saw the reviews, they were very positive as well as what people said on Reddit. Something we could also do is look at the Datadog reviews and just see what people say on the official websites like G2. Let's just see what they say. So 4.2, that's pretty good for IT. A lot of 4.5 for a good for getting stats. Datadogs, okay. UI easy, simple to set up. That's great. The UI, okay, that's kind of contradictory, but okay. Let's see what else people are saying. So cons, expensive learning curve, documentation issues, missing features, data dashboards issues, ease of use, user interface. So it's kind of like contradictory. Some people, maybe they like certain things, other people don't like the same things. Okay. What do you dislike? The pricing? Yes, the pricing could be a pain in the ass. Okay. Good to have product for getting stats. Okay. The costing. Okay. So the main concern is the price, which is, like I said, is a very positive thing. Okay. Let's see what this person said. Broad suite. Okay. Okay. So the pricing. It really comes down to the pricing, guys. That's what we see right now. But other than that, the company seems to be offering a really good product. So now we've analyzed the market, we've analyzed the product. Let's look at the management team. Let's see what's up with them. So Datadog management team. So we have a page called leadership. Okay. Wait, I just want to know what's going on here. This kind of stood out. Oh, okay. Never mind. So we have leadership. Oliver, so he's the CEO and co-founder. Okay, Oliver Hurl, engineering progress, so very experienced. I like the fact that the original founders are still running the company. That to me is a good sign, because usually they're the ones that really have a vision beyond just filling the pockets of shareholders. And that's ultimately what creates a lot of excess shareholder value, in my opinion. That's really good. Looks like they got some good people behind them. Ooh, CMO of Twilio. That's powerful. That's powerful because Twilio is a monster. They're really good at marketing, and the market is kind of similar, so that's great. Okay, I think that's great. Board of directors. Yeah, it looks like this person is somebody from their early funding. Oh, wow. MongoDB. Wow. MongoDB is a huge company. For them to have this guy, that's pretty solid. Yeah, they got a really, really solid team. The one concern in that is the most important thing for us to look at is the founders themselves, because probably they have the biggest say in the company. They've been in the company the longest. So something that I like to do for that is, well, first I want to read more about them. So before I go into YouTube and put like a video interview of them or anything like that, let's see what they've written about them. I want to know about their story, see where they come from, see what's going on. Okay, this is great. This is great because these articles are good to know more about a specific person. This is gonna be a good YouTube. This is gonna be okay. This is gonna be great too. Now, don't worry, I'm not gonna make you watch these videos with me, but I'm just showing you the process of what I do. Let's look at the co-founder right here. Let's see if he's got any features or anything like that we can kind of look at. Okay, so he's got a Forbes profile. That helps. Crunchbase. Okay. He's an angel investor, it looks like, too, which makes sense. I mean, okay, let's see what they have right here. So his net worth is $3 billion. Just $3 billion, guys. Not a lot. Very humble net worth. Okay. He's 47. That's also important to look at, to the age, because the older they are, the least likely they are to stay with the company. So he's a billionaire. Okay. Let's look at the compensation. 11 million comprised of 3.4% salary, 96 per. Okay, that's great, including companies directly owns. Okay, so he's paid in shares a lot. I wonder what the compensation is based on. So this blue is stock award value, but what does that mean? That's what we need to figure it out. Okay, let's see this. Oh, this is the, okay, 90,000 per year salary. Okay. Yeah, it doesn't say how. So that is something where I'm not gonna get into right now because I can't find it, but that's something really important to look at, to see like what is the compensation, the extra compensation outside of their base salary on. So he's an investor as well. Okay. He's helped provide some seed funding for different companies. Okay, that makes sense. So he's saying that he sold some shares. Now that's normal because a lot of these people, now that you've taken the company publicly, you kind of want to liquidate and use that money to preserve your wealth, maybe invest in certain things or buy certain possessions that you've always wanted. Oh, that you've always wanted to get. Yeah, so there's not a lot. Let's see what we can find about the co-founder. Yeah, there's not a lot about the co-founders here. Let's see if there's something on YouTube. Maybe there's like some type of short video where they talk about their story. That would be helpful. Let's see. This could be helpful. Yeah. We also have the other videos there. So let's just watch this one together right here. Let's see.
Cloud monitoring, cloud security is so much of what you do. I want to ask you about this SolarWinds hack we've been talking about over the past few weeks. what is it about your monitoring, your technology that fits into this
That's
storyline?
funny,
Is
he
this
got
something
stuck.
that you could have detected, or that you're building any kind of resources to monitor against in the future?
Well, so first, hi. Yeah, so the SolarWinds hack, definitely a very big one, I would say. Not especially surprising to see new important hacks like this one, but definitely a very impactful one. I think what it makes very clear is that there's going to be even more of an arms race when it comes to security. And it's not surprising. Companies are transforming, they're having more and more of their activity that is happening online, is happening in software. And so there's much more that can be done by attacking that software. So what we do is we gather as many signals as possible across observability and monitoring, which is the where we come from, and across security. And what's interesting here about the SolarWinds hack in particular,
You've seen growth where your customers have experienced strong demand, streaming, online education.
to have momentum. This year, we've seen fairly brutal changes in patterns of usage in the cloud. As you can imagine, so streaming, as you mentioned, all of a sudden everybody's kids were watching Disney Plus, video conferencing, online gaming, all of that, spiked pretty quickly. But even if you think of the domains that were negatively impacted by COVID, such as travel, uh, when all of a sudden everybody had to cancel their travel, it actually meant a lot more activity for the online sites of the travel companies. Do everything and ship that to their data centers. They could do that very
Those
quickly.
are very solid
So we see that as a
customers
big
to
one for
have,
the cloud.
yeah.
Next year,
Okay, so what we can see from this video is that, he seems to know really what he's talking about. But what I want to do as part of like this in-depth analysis is go through these interviews right here. I'm not going to make you watch them with me, but what I'm going to do is I'm going to stop the video right now, watch them, and then I'm going to tell you my thoughts about what I found from reading this. And from that, we're going to be able to finish our section of the management team. The one mark that we left is understanding more how the compensation really works with the shares that they get. Okay, so I watched the two videos, and what really stood out to me from these interviews is that the founder and the CEO of Datadog really knows what he's talking about when it comes to understanding data analytics, when it comes to understanding monitoring solutions that companies need. He also really seems to understand the customers that they're targeting and the different products that the company offers. What really stood out also to me was him sharing his experience and his background in the past and how he got into data analytics and performance monitoring. It was very helpful. And then also he also gives an overview of how the industry evolved over the years, how it was before, which was pretty much in shambles before, very complicated, very much a pain in the butt to deal with. But now with the new changes and what the company that he founded is doing, it seems like that transition has been really helpful for companies to really understand how their products are being used and when errors and bad things happen on their platforms. So that was very helpful. And then the other video that you can see right here, he gave some very helpful tips that shows that he really knows what he's talking about when it comes to not just running the company, but also generating growth from the company. So in this video, he talks about like their current organizational structure and sales structure that basically combines salespeople with product-led growth to generate a lot of the product and revenue growth that we see from the company. So overall, very good things, and we can go ahead and give the check mark to the management team. One thing that we could also do, I'm just gonna pull it up because why not, is to be able to look at the insider trading of the CEO. So for example, what we could do is Datadog insider trading. And what this is going to tell us is whether or not the insiders, meaning the board of directors and the management of the company, are selling different stocks. So this would be all the transactions. So right now it looks like there's been a whole bunch of selling. and not a lot of buying, just a few transactions over here. And then this is their relationship with the stock price, which is interesting. Now, one thing to look for here is that sometimes the top management of the team, they're selling what seems like a lot of shares, but in reality, that's not the case. They have a selling plan where they're selling a specific number of shares per month or per quarter. So something to keep in mind. And then we can also look at other sources here to see what they're saying. So here we go. We got 17 buys versus 34 sales. And then we can see who is buying and who is selling. So here's all the different trades. So this is the other co-founder and this is the CEO. You can see this is exactly what I mean. Automatic sell versus acquisitions. So here we go. So if we look at buys, we can see who's buying. Jacobson Matthew, we can see who this is, and who's selling. Well, we already know the management of the company selling, but it seems like this is an automatic sell, so nothing to panic. Let's just see who this person is. Oh, so he's a director of Datadog. Very interesting that he's buying shares of Datadog and GitLab, where it seems like he's also involved as a director. So something important to keep in mind. And with that being said, now we have all these different tenants completed. Now we need to get into the numbers and the weeds when it comes to the quantitative analysis of the company. So we're talking about valuation and company health. So first, what I'm going to do is I am going to get rid of this because we don't need these notes. These are for Atlassian, I believe. And here we have this model. I'm not even look at any models right now. What I want to do is assess the financial state of the company. So as you can see, I have the financial statements for Atlassian. We're gonna do the same, but this time for Datadog, so that we can see how the company has performed financially over time. And let's do that right now. So we have Datadog. We're gonna select annual data. Annual data is generally the best, so you can see how the company has performed on a yearly basis. And here we go. I always like to start with the income statement because it's one of the most important financial statements. And what we see is, so 2017 revenue was 100 million, 198, 360. So as you can see, tons and tons of growth from the company, maybe less so this particular periods of time. Something we could do is calculate the revenue growth. So we take the latest revenue minus the previous, all divided by the previous number. So we can go ahead and do that. Drag this formula across. And as we can see, this gives us the revenue growth on a year-to-year basis. So 27%, yeah, this is what I mean, not as high. 63, 70, 66, so very, very high growth except up to this point. Now, the question is this gonna continue on the same path or continue to decrease or go up? We don't know yet. We're gonna do our analysis to find that out. Okay, so this is helpful to know. Just gonna bold it here. Gross profit, very good gross margins for the industry. We can do industry analysis to see how the companies compare, but because I'm sort of in a similar industry and I've done research on this, I know that these are good numbers. And then we can see the other expenses. So we see a constant and quite drastic increase in research and development, steady growth in the selling and administrative cost. Okay. EBITDA, we can see that is positive, which is a good thing. A lot of these companies are losing money. Interest expense, depreciation, and amortization. And we see that the company for the last 2 years has lost money. In this case, 24 million, and this year, 33 million. This is 2023. Okay, great. So that's the operating income. This is not the net income. So we can see that the operating income is negative for the last 2 years, positive for the previous 2, and then negative for this. So this is probably because the company here was preparing to go public, if I had to say, or it went public and it decided to, this is during the pandemic. So it decided to really prioritize being able to at least stay profitable or have minimal losses. The net income, we can see that the company did generate a positive net income in the last year and then negative income for all the other years. So this is why the earnings per share is positive for this year and for the other years is negative. Now, this is really critical. We want to see the growth or decrease of the shares outstanding. So as we can see, we started with 79 million shares and now we're all the way to 324 million shares. So that is a massive increase in shares. Not the best sign for shareholders because it means that you're going to get diluted. So something to watch out in that arena. Now we're going to move to the balance sheet. This is really important. So we can see current assets are increasing. That's good. Non-current assets increasing as well. Most of the assets are short-term investments, which is good. And then in this case, goodwill and intangible assets. Interesting. So the company has been acquiring other companies. And goodwill, yeah. Okay, let's see current liabilities. That's a lot. This is $1 billion in current liabilities and non-current, 907 million. That's a lot of current liabilities. Okay, this could be a source of concern. What's the most in here? Okay, this is not bad at all then. This is not bad at all. So most of the non-current liabilities is deferred revenue. So let's say like, yeah, somebody paid for an annual price plan, but then maybe they just haven't paid for the first 2 months. That means that for the other 10 months that you have that contract, because it's 12 months in total, you have not performed the service to receive the revenue. So this is why deferred revenue is not bad, because it means that as long as they perform the service that they were supposed to deliver to their clients, then this gets off the books and they will be okay and they'll be able to collect. Just to get it off the book because the cash they already collected for these revenues right here. So that's great. So other than that, there's actually not a lot going on. And if we compare their current assets with their current liabilities, we can see that the company seems to be in a very good financial position. So as you can see right now, this is a 3, which is okay, not the best. But if you subtract the deferred revenue, then you're really in a good position. So let's do that. So we're going to take this and then we're going to subtract the deferred revenue. Here we go. Now we're looking at 13, which is great. And then even better for the other years. Okay, great. That's good to know. Long-term debt is decreasing now too, which is good. Before the company had no debt. And then total liabilities, okay, 2 billion versus total assets about 4 billion, okay. Stockholders' equity. This is very, very important because ideally what you want to see is the equity of the shareholders increase over time. And this is what we see here, which is a very positive sign. And then total debt, net debt. Okay. So overall, I think the company financially seems to be pretty good. It's not the best because it doesn't have a long history of making tons of money and having a lot of cash like other companies like Apple, for example. But for a relatively young company that IPO'd, I believe, 2016, 2017, this is pretty good performance. I mean, yeah, I gotta look at what the other similar companies are doing, but this seems pretty good margins. Not too much debt, shareholders' equity increasing, dilution, that's the only thing that's kind of bad. Let's look at the cash flow now because this is going to tell us a lot. So as we can see, we have the net income right here and then the net cash provided by operating activities. Yeah, it's always been positive, which is a very, very good sign, and it's increasing over time as well. Net cash used for investing activities, always negative. Yeah, this is exactly how it should be because it means that the company is investing in growth, which is what this company has planned in order to be able to grow the share price and the company itself. Let's see what the company is investing the most. Purchases of investments. Interesting, okay. And then here we have provided by financing activities, okay. Issuing stock is big for the company. This is why we have the dilution. And then here they bought some stock, which is interesting. And then the free cash flow of the company is positive and it's growing over time. This is very important because this is the actual free cash flow that the company has to be able to reinvest in new growth initiatives, provide dividend payments, which we already saw that the company is not doing. So in this case, that wouldn't apply. And even buy other companies or make any other investments like that. Then we looked at the key metrics. Let's see how we're looking here. Return on invested capital. This is negative because the company has losses. Market cap increased over time for the most part. Enterprise value, same thing. P/E ratio, wow, 809. And it's been negative because of the company's losses. Price to sales ratio, this is important. This is something we're going to look at later. Let's see what other ratios. Price to book ratio, okay. 19. Okay. Seems like a lot, but for a lot of tech companies, that's not even that bad. Current ratio, we already calculated here. Dividend yield 0. Gram number, ROE, return on equity. Okay. Okay, great. So overall, just looking at the financial statements, financial health is actually not bad at all. And the one thing about all these different tenants right here is that if one of them is bad, then you might as well forget about the company. But if all of them are good, except maybe like the valuation, then what you can do is find the value of the company, and let's say it's like $50 per share. I'm just making this up. What you can do is say, okay, you know what? In my analysis, the company is worth 40. So if the company reaches that point later on, then you can invest, assuming that everything else remains good as it was before. So that's a very important strategy when it comes to this investing. So company health, for the most part, is done. There's one spreadsheet that I really like here. If we go to sheet 1, by the way, if you want access to the spreadsheet, I'm happy to share it with you. Just leave a link in the comments and I'm gonna share with you the link. So as you can see, we have the company right here. So DDOG, so that would be Datadog. And now we have some formulas that get the data. Now in this case, there's a little mistake, but we're gonna fix them all. So if I click on replace, click on this, replace all. Okay, we gotten rid of all that nonsense and now we're back. We have our numbers back. Okay, so here this is gonna give us a TTM and it's gonna tell us the revenue, the market cap, and so on. So let's put this right here in this format. We can see revenue looks good. Even on a TTM basis is increased. Our market cap looks good as well. The company's increasing in value. So if I had to say right now 40 billion, okay, in market cap, that seems like a lot. We'll see if the price is justified. Revenue growth, TTM is not available, but you can see the other ones. Okay, so this is basically the same. Price to sales ratio, we already looked into this, but we can see how it's fluctuated over time. So it looks like the lowest price to sales ratio here was now, or here, 14.5. Interesting. P ratio, yeah, very extremely high. Market cap growth, so it looks like, yeah, the company has for the most part increased in the market cap, and you can see the projection here. Huge jump. When was this? 2020. Oh well, by the end of 2022, and now it's kind of going back a lot, and now it's kind of going back again, which is interesting. And I always like to compare this because the revenue of this company is always so small, but at least it gives you a positive direction of the trend right here. Now, if the company is generating this revenue, is it worth this price? That's what we gotta find out. The other thing that I like to do is look at the price to sales ratio on a quarterly basis. And as you can see, yeah, so this would be quarterly divided by 4. This would tell you what the equivalent price to sales ratio would be. So the lowest ever, we can calculate. I believe it would be, yeah, it would be this. But we can calculate just to show you how you can automate this part too. If you do min, select your data, this will tell you, and it would be around 8 probably. So 9 would be the lowest. Maybe that's what we'll take for our analysis. Maybe that's what we'll take. Okay, great. Now we can start to play around and do the valuation. So we already know the ticker, DDOG, okay. As you can see, because I'm using Y-Sheets formulas like this one, this is pulling the latest data, which is very helpful. And then here in this very simple model, I like to start with some very simple models. Obviously, you can do some more complicated analysis, but for SaaS companies, the great thing is that a lot of them, they're just valued on the price to sales ratio, especially companies at this stage that have this good of a quality in terms of the tenants that we talked about right here. So this is good to just kind of play around. So Datadog projected growth rate. So this is where it gets interesting. Something that we could do is do our own research, or we can also look at analyst estimates to see how the company is projected to grow. So in this case, we have 27%. Interesting. Projected revenue growth, Datadog. Okay, so we can go here to Yahoo Finance. They have some good estimates. Sales growth. They have one for the next 10 years. So they have 16%, which is interesting, average. We can take that. Yeah, we can start it. I like that conservative figure. I think that's realistic too for the company. So we're gonna go back and let's just say we're gonna do 16%. Okay, projected terminal value. One that I really like to do is the lowest one. Even though sometimes it's not the most realistic, the lowest we had here was like 9. So let's just start with 9. Let's see what 9 gives us. So we have this, and then yeah, we have the calculation right here. $127. Okay. The discount rate. I like 15% right now just because interest rates are pretty high, but yeah, you could do like 12%. That's reasonable. You could, I wouldn't go maybe 10%. I wouldn't go lower because of the level of risk and the level of maturity for this company. I wouldn't go lower. So let's say 12%. This is the present value of the market cap. This is the present value per share. So right now with these estimates, this would tell us that Datadog is worth $72 roughly. And then the current price is $121. So we have a downside of negative 40%. Now we can of course tweak the numbers, but I don't know if there's much to tweak. I mean, the projected terminal value right now, what is it? So right now it's 17. Wow. But the thing is, like, if the company grows at 16%, to have a 17, that wouldn't make sense. The most I could see is maybe a 20, and then that is if the company has 20%. So interesting. And this also, by the way, sensitivity analysis is really, really helpful here because this tells us if the revenue growth is this percentage and the price to sales ratio is this, at what point am I actually going to make this investment profitable? So in this case, we see that only if the revenue growth is 25% and the price to sales ratio is 12, this is the only one scenario where we would make a profit. Obviously not the best luck, so just something to avoid, but it is what it is. Yeah, and even this would give us a 3% CAGR. Okay. Yeah, guys. I could do more research to see different scenarios, but I think this is pretty accurate. So the most we get is 114, the price is 120, so we have upside downside of 6%. So in this case, I think what we're gonna need to do is everything is great about the company except the valuation. So just make a note that according to your calculations, the price is roughly 114. And then once the price reaches lower than that, then that's when you could start buying. Now, the one caveat that I want to give is that, as Warren Buffett mentions, it's very important to have a margin of safety. And a margin of safety is the higher the better, but to have a really high margin of safety sometimes is unrealistic. So maybe in this case, like we have a 40%, maybe a 30% margin of safety. So you would take this. If it's a 30% margin of safety, we'll take 70% of this. And according to this would be what we would be willing to pay for Datadog. I know it seems low, especially compared to the current price, but a lot of these companies, they're really overhyped. And the only way it could be worth more is like, maybe like the revenue shoots up to 30% and here we get 15. Now we're looking at a different scenario where, look, now the numbers are completely different, but I don't know. Right now, based on the analysis that we've done, I don't see it being realistic. Now, there's other ways of valuing the company as well, so you would have to go and do that as well. One more thing that I want to share with you before we wrap this video up is that one of the things that I like to do is to go on Seeking Alpha and see what the analysts are saying about this particular stock. This is one part of the process that I like to do at the very end because I don't want to look at the analysis first and then have that cloud my judgment. I want to do it at the end to see how it compares to my own analysis. So in this case, we're going to enter Datadog. Datadog, okay. I think it has to be one word. Okay, here we go, Datadog. And then right here we go into analysis. Yeah. Here we go. It's not cheap, but the best are rarely on sale. Yeah, so I think a lot of the price hype is built on generative AI and new technologies like that. So I don't know if it's the best time to invest in the company right now. One thing to look at this is the date of the analysis. Like if you look at April, it's very different than now, right? This is why I like to look at the latest analysis. Now here we might get hit with some type of paywall. Yeah, the price is very expensive right now. Oh, really? That's interesting. Well, this is fair. I mean, the company is very high quality. Risk to the investment thesis, yeah. Yeah, the platform is very good. Valuation. Yes. Yeah. Yeah, this is what we're talking about. It's hard to continue to grow at those very high growth rates. Yeah. Yeah, this is kind of like a bullish, quite a bullish take on the company. Here, there's some comments too, which sometimes are interesting to read. Let's see what they say. Yeah. This is now paywall, so I can't access this. But anyways, you get the idea. With that, we conclude this video. I hope it was really valuable so that you can analyze stocks in this way. And of course, this is not an infallible way. There's many different aspects where there's room for improvement, but you can use a lot of the techniques that we talked about in this video so you can adapt it to your own analysis and your own investing style. But I hope this was helpful, and if it was, make sure to leave a like, subscribe to the YouTube channel, and I'll see you in the next one.